This is how you can really get some money with the stock market. It's like borderline easy. We ain't gonna sell you no course on it. This shit is free. This strategy revolves around selling options as opposed to buying options. So when most people are trading options, they're buying, right? Which is a higher risk strategy. Selling options is a low risk strategy that'll make you some motherfucking bread. And the wheel strategy, man, break it down for them.
It's super passive. It may take a little bit of an adjustment if you're just starting out in the stock market, but just bear with me, take notes. And this is really, really cool. And again, none of this is financial advice. I'm not going to tell you to buy any of these stocks. This is just for educational purposes only.
Yeah, man.
You might be asking yourself, hey, why should I listen to this geek? Well, you might want to listen to me because I'm a professional chartered market technician. I've been trading and investing for 8 years. And I also am a certified options trader. I was certified by TD Ameritrade back in like 2019. So
yeah,
I do know options. I am a huge geek when it comes to them. Okay, so what is the wheel strategy? Write this down. It's an options income strategy. So it's not a growth strategy. It's not a day trading strategy. And understand that options are extremely risky, especially if you don't know what you're doing. That's why we're here to educate you.
Yeah.
We're selling a put or we're selling a call. Again, we're selling options, we're not buying them. Again, you can only sell puts or sell calls, or you can buy calls and buy puts. We're talking about selling them though. This requires the capital or cash to buy 100 shares. Double underline that, because if you don't have the cash to buy 100 shares of a certain stock, you can't do this strategy. It's tougher to do on much higher priced stocks. So think of like Chipotle back when it was $3,000 a share. Unless you got 300 grand, you can't do the wheel on Chipotle stock.
But you could do it on a less expensive stock. And that's what we're going to show you.
Yeah. And I can show some live examples too as we go throughout. So why should we use the wheel strategy? Well, it's actually lower risk compared to other strategies like buying options. When you're buying options, there's a very high probability that you're going to lose money. However, when you're right, you're going to get paid really, really well. So this is kind of like the opposite. You're going to get that steady income, but you're not really going to get too many big wins from this. And shorting stocks, you technically have infinite risk, because if you bet against a stock, you lose money if that stock fists upward. Okay. So when you're shorting a stock, you want the stock to drop, but you can lose infinite amounts of money when it goes higher. This isn't a risky strategy like that. We have predefined entry points and predefined exit points. Super cool. So you know exactly what you're getting into ahead of time. It makes the risk clear. It makes the reward clear every single time. The cash that we collect from selling the option is guaranteed. That's right. This is guaranteed if you hold the trade until expiration.
Guaranteed. Yeah.
Guaranteed. It's the only thing that's guaranteed in the stock market. The cash collected from selling an option if you hold it till expiration. This generates consistent income every week, every month. Some stocks you can actually even sell bi-weekly options or even daily options like SPY, S&P 500. So that's super cool. What's cool about the wheel is that the wheel can outperform a lot if the market stays sideways. So think, you'll really do well if the stock market just goes dead sideways. You collect cash on the bottom side and you can collect cash on the top side. You don't really want the market to go straight up or straight down, because otherwise another strategy might be better. Cool. Step one, write this down. Sell a cash secured put. Look at this guy. He's happy. He's selling a cash secured put.
Yeah, he is.
You need cash in your account, your trading account, to be able to buy 100 shares of the stock at whatever price that we sell the put at. We call that the strike price. You're obligated. You are on the hook to buy the stock at the strike price of the put. Okay? You have to do it. You're committed to buying the stock. So you don't want to do this on a stock that you don't want to own. You got to be cool with owning this stock. Because you're forced to buy the stock at that price, you get paid a premium, cash money. This is your guaranteed profit for making that commitment.
That's the key, the premium. That's what's guaranteed. You're going to get the premium immediately.
Immediately. It goes straight into your account, but your buying power will be held aside to be able to buy 100 shares. And then what happens after that? So the cash is collected right up front. You wait until expiration. So options have an expiration date. That's why they're a little bit trickier in nature. It's kind of like 4D trading, you know? It's pretty intense because it's how the stock goes up, how the stock goes down, and then also the time factor for the stock. Okay, so you wait until expiration to find out if you have to buy the stock or not. This helps you get paid to buy your stock, and it lowers your entry price. So just think, make that commitment, you get paid to buy your stock, you get a lower average cost or lower entry price. Want to buy low, sell high. Example number 1, selling a put on ABR stock. Let's say you want to own 100 shares of stock ABR. We've been wheeling this stock for a long period of time. You want to sell a put at or below the market price, ideally below market price. This is what gets you a good deal and gets you that cash money. This is past that expiration date. But let's say I want to buy the stock at 14. Okay, if I limit 0.2 credit to open, that means I get a guaranteed $20 bill. You get a Jefferson. Translation, I'm putting up $1,400. So that's what your commitment to commit to buy 100 shares of ABR stock at $14 a share by the end of the day. Because of that commitment, I get that guaranteed $20 bill. Only one of two things can happen. Once you've sold that put, you entered the trade, that's it. At expiration, the stock's gonna be above 14 or it's gonna be beneath 14. If it's above 14, guess what? You get all of your cash back plus that guaranteed $20 bill. If the stock is beneath 14, guess what? The broker will automatically buy 100 shares of ABR for you at 14, and you still get to keep that $20 bill. So that's the cool thing about it. The $20 is guaranteed, but at expiration, you have to buy the stock if it's beneath your strike price of your put. It's a win-win.
If it's above your strike price, they give you your money back and you keep the premium.
Yep, you get all of your cash back, $1,400, plus that $20 bill, you get $1,420 back to your brokerage account. If let's say ABR stock closes underneath 14, this is just like the risk is if you were to buy the stock. You would be down on your shares, but you still get to keep that $20. So your average cost is really $1,380. That's what we call our break even.
Let me show them. I'm gonna show them what that looks like in Robinhood. All right, so yeah, I don't own any of this, right? So it's just we just on here, right? So, but if I wanted to sell a put in here, so what do? I go to trade options on ABR.
So you want to buy ABR is what you're saying,
right? So we're gonna sell a put. We need to pick an expiration date. This is when the put expires. I like to do mine a week out. For me, when I'm selling options, I want to make 1% a week. You do that, you make 1% a week, 4 weeks in a row, man, that's a month. You made 4% for the month. But it compounds week to week, right? Now that's how you can beat the market with the shit, because the actual S&P is average is 10% a year. So anyway, so I'll pick a week out, boom, 10 days. This is the share price. This is how much it costs right now, $15.50, right? Boom. All right, so if I go here, I pick the strike price underneath. This is my strike price underneath. So check this out. Basically, I'm saying if I sell this put, what happens is it's going to cost me $1,500. Yeah, $1,550, right? In this account, right? And I'm going to get $25 immediately, right? So this is what's called the premium. So basically, I'm going to get this immediately. This $25, which is more than 1% of 1,500. So I'll be making more than 1%. Now, here's the thing. You see this? If it's at 15.5, 8 days from now, on this date, then what's going to happen is if it's this or lower, then Robinhood is going to hold this money and they're going to give me $25 for that, right? And if it hits this or lower, then it's called getting assigned. Well, Robinhood is going to take this and I'm gonna own 100 shares of this stock, because one options contract is 100 shares. Just remember that. That's why you only do this on a stock that you wouldn't mind owning. All right, that's fair. So let's say I'm fucking with ABR, like that's my shit. So like if it happens, that means I just buy it for cheaper. I buy it for cheaper than it is now. Now here's the beauty of it. If it closes above this strike price 8 days from now, then Robinhood gives me this money back, but I still kept the $25. So what that means is, like, I can't lose. One or two things gonna happen. I'm either buy the stock I wanted for cheaper and I get that 1% premium, or I get my money back, but I still keep the 1% premium. This is why I rarely just buy a stock I wanna own long term. I always sell options. I always sell puts to get into it, because I can get it for cheaper than it is right now and I get paid to buy it.
The way that you will probably learn best is actually by doing it. When you do it, you'll learn really, really quickly.
You can get something cheap, like a cheaper stock than that, right?
Yeah, you could do it with like a stock like SoFi. It's only like $6.50.
Yeah,
You still only
is like under $10, right? Something like that.
Really, any stock like underneath $50, that just means you just need less than $5,000 to do one of these cash secured puts. That's a great way to start.
And I like to get 1% every week, right? If we don't get assigned, we just get our money back and we keep the premium. So we do the same thing again next week. That's not the wheel. You just keep selling puts until you get assigned. That's when you do part two. Go show them part two.
It's amazing. It's amazing. So like Brandon said, you're either going to get your cash back or you're going to own the stock. You're either going to have a ton of cash in your account. It'll happen on Saturday because expiration dates are usually Friday. So your broker will have all your cash in your account on Saturday, or you'll own the stock, 100 shares of it on Saturday. What's cool about this too, I just want to note, is that this is scalable. So like, while I may only sell like 2 cash secured puts on a stock, Brandon or Romulus might do like 10 or 20. And that's where the real dough starts to come in.
Yeah. And you might get assigned too. You're going to get assigned eventually, right? And that's okay, especially if you don't mind owning the stock. Like sometimes I'm just selling puts on stocks I want. It's not even the wheel. I wanted to own that anyway. You know?
And we're just talking about the bottom side of the wheel right now. So let's assume that we got assigned. Okay, we've got 100 shares of stock. You got assigned. Now what? This is an example of a cash secured put. By the way, I did this on Tesla, TSLL. This is exactly what an Optimus alert looks like. Sell to open the 8 put, collecting $15% of my portfolio. Boom. Tesla obviously has rallied very hard. Really, really nice trade right there. Now we've got assigned though. Let's pretend that we've got 100 shares of stock, and I actually have 100 shares of ABR, so I can show this on my Thinkorswim right over here. So this is a daily chart of ABR stock, a real estate investment trust, pays a nice good dividend. I like the stock. Romulus like the stock. I own 100 shares of this stock and it's doing very, very well. I sell covered calls each and every week. Just one covered call because it's just a small part of my portfolio. If you go over to the option chain, you can sell a covered call now. So now I own the stock. Now I'm gonna come back to ABR and I'm gonna go back to the presentation. So this is selling a covered call, the top side of the wheel. 100 shares of the ABR from selling the cash secured put. We own it now. We want to sell a call option at or above your average cost. What does that look like? Well, in this example, I sold the 1550 strike covered call. I only collected 7 cents for this. So I got paid $7 basically to agree to sell my shares now. So now we're getting paid to exit our stock. First, we're getting paid to enter our stock. Now we're getting paid to exit our stock and take profits. And so this is really, really cool because again, this reduces the risk of owning stocks. You know, you're collecting cash money as the stock goes sideways. We'll talk about the downsides and the quote unquote risks with this as well. Okay. Again, this is guaranteed cash outcomes. The stock is either going to close at or above that strike price. You keep the cash no matter what. But if it's above the strike price of the call, you get what's called called away or assigned away. It's another win-win. You get the guaranteed cash and you're either going to get out of the stock or you're going to keep the stock and you can wheel it again. You can sell another covered call the next week. Here's an example of this stock called ASC. So I bought 100 shares of this. Boom. That's up 6%. That's up $85. But what I did was I also sold the 15 strike covered call. This is what it looks like. Short -1. Okay. Currently this trades up $95. There's an example of the daily chart and the stock is a lot higher right now. The stock goes sideways to slightly higher. That's perfect for the wheel strategy. So you don't want to do the wheel on a stock that might be tanking. As time passes, notice the stock actually dropped a little bit. I'm now only up 5% on this. But since time passed, the theta decay chipped away at the call. And look, I'm up even more money. So look, $95. Stock drops a little bit, but time passed. I'm still up. So that's what's super cool about it. It's called being positive theta. When you're buying an option, you're negative theta. You're just losing money to the option seller.
Hold on, let me break that down a little bit more, like the selling option part. So let's say you get assigned. There's a stock I own, Simon Property, a real estate REIT, and it's mostly malls, right? So I think like Lenox Mall in Atlanta, Fashion Show Mall in Vegas, like the really nice malls, like where the luxury items are, where any mall they got a Louis Vuitton or Rolex or Gucci or some shit, it's probably a Simon Property Group mall. All right. Anyway, so I own 500 shares of this. You can see I'm up 126% on this stock, right? You know what I'm saying? I own 500 shares, right? So because my average cost is $65, I'm way up, right? So what I do is I can trade options, boom, selling a call. Here's what the share price is, boom, and anything above the share price, let's say, boom, for 100 shares of this shit, instead of using money as collateral like we did when we selling the cash secure put, now I'm putting up 100 shares as collateral. They're gonna give me $20. Boom. They're gonna give me $20 to put up my shares as collateral. Now, one of two things are gonna happen. The expiration date is a week out. This is the strike price. A week from now, 8 days from now, if it closes below my strike price, then I keep my stock and I keep the premium they gave me. If it closes above this, then I keep the premium still, but then that means I have to sell the stock at that price, right? Now, it doesn't matter because I'm up like fucking 150% on this stock. I got paid to sell the stock for profit. And that's the wheel strategy. You get paid to enter with a cash secure put. Then you get paid to sell with a covered call. I hope that makes sense, right? So I've been doing that with this for like years. Truthfully, for this one, I don't really want to get assigned, so I'd probably pick a higher strike price. You get less money.
You'll still get a bigger profit.
Yeah,
and you don't have to sell covered calls if you don't want to. You can just hold the stock.
You can just hold the stock. Sometimes, some weeks, I don't know if I want to get assigned, but sometimes you get assigned too, right? I was doing this shit with Apple for a long time, and I got assigned, and I had to sell Apple, but I sold it for more than I bought it for, so I got paid to sell it, so it was a win.
I remember also you did that with NVIDIA, which was a monster win.
Yeah, it just went up. It went up so fast that I got assigned on the way out, but I still made a lot of money. Yeah,
it's just a great way to trade. It's a great way to swing trade because you're not trying to time up the entries and the exits. Mm-hmm. You're not like a day trader trying to like buy dips and sell rips and time the market. No, you just look at the option chain. You say, do I want that much premium or not?
Last year I had like a lot of money in my I liquidated a lot of it for some other investments. With the wheel strategy, I was making like $10,000 to $20,000 per fucking month, right? With my portfolio by, either selling covered calls or cash secure puts. I was just wheeling my shit the whole time. But it was a lot of money. It was like close to $1 million in there at the time. Yeah. I bought this watch selling covered calls and cash secure puts, basically wheeling stocks. That's how you use assets to buy luxuries, right?
It's just like a great way to trade. It's a peaceful way to trade because all you do once you get the hang of it is it only takes like 2 minutes on Monday morning to just sell the covered calls, sell the cash secured puts, boom. So we're combining both steps, okay? So after we're selling the covered call, we continue to do that until you're called away. So you just keep getting that weekly cash flow, okay? So combining these steps. Once you're called away, we start over. You do the cash secured put, and you should have a ton of cash in your account right now. So we just sell a cash secured put again. Repeat this process to generate income. I would rather make 10% a year with cash flow than just have a 10% gain of just growth, but no cash flow.
You get the cash flow from this shit. Especially stocks that don't pay a dividend, you can get a dividend out of it. You own it by selling covered calls against it, like I did with NVIDIA.
It's absolutely amazing. So yeah, why does the wheel work? Income generation, it beats out dividends and can pay bi-weekly, weekly, monthly. Most dividends usually only pay quarterly. So every 3 months, a stock will pay a dividend usually. But this, you can get cash flow each and every week.
Like that Simon Property, it pays a huge dividend, but I'm still getting money off it from wheeling it.
It's just like a great way to trade. Exactly just like with ABR, it pays a dividend. So boom, you get that cash flow coming on in. Boom, you get cash flow from the wheel. It really just reduces your overall risk in the stock market. It's also super cool because you can be flexible. You can adjust your strike prices for your goals. You can sell out options that are further out in time. You'll get more premium, but you'll have a lower frequency of cash flow.
Yeah.
And that's something to think about as well.
Some people do it monthly. I do it weekly.
Yeah, exactly. Some stocks only have monthly options, monthly expirations. They're called monthlies. And that's fine too. I mean, you'll get more premium. You just have to wait longer to let the options expire. And what's cool about this is you get to predetermine your entries and your exits. So that's really, really nice. You know exactly what's going to be going on and the market will just dictate how well you get paid over time. And again, what are the risks with this? You know, if the stock absolutely tanks, yeah, you're going to lose money. If the stock goes bankrupt, you're going to lose money.
That's why you don't do this with stocks that you wouldn't mind owning. At some point, you're going to end up getting this sign. But it might be a good thing. That's why I own 100 shares of Netflix. I was selling puts against it, and then one day I got a sign, but then the stock went way up. So it's like it ended up being a good thing because it was a stock I wanted. That's the key.
And that brings up another point. Netflix is a tech stock. It's more volatile. It has what's called a higher beta. And so higher volatility in stocks means more premium. So you'll get paid more cash to agree to sell the call or more cash to agree to sell the put. So it's really cool. And again, I help out people all the time. I help out White Boy Brian. I help out Jonathan. I'm like, hey, what kind of strike price should I sell? I'm like, hey, do this. And then boom. This is what selling options looks like. As time passes, boom, he's making money. Another example of this that you want to think of it like is imagine you buy a property and then you rent it out. That's basically what's going on. Rental property, selling a covered call is like collecting rent. You're renting out your property. Of course, the home value can go up and the home value can go down. You're not maybe so focused on the actual value of the home. Sure, you don't want the home value to go to zero, like you wouldn't want the stock to go to zero. But when you're selling covered calls, just think of it like you're collecting rent, except for you don't have to do the whole hassle with real estate. I like real estate too. It's an alternative asset class, but it can help you diversify. Yeah, I had to sell a lot of stocks to buy my home as well. And it's
come on, man. But it's dope that when you can do that.
Yeah. So just a quick recap and some quick tips. Select a stock with strong fundamentals. Don't do this on no shit stocks, okay?
Nah, don't be doing this shit on motherfucking GameStop or some shit, man.
The premiums are high on GameStop, but they're high for a reason. It could go bankrupt. You know, look for a history of stable price movements. You know, it depends on the market environment too. You know, contact your local CMT if you want to learn about forecasting stock market prices. Because if you know that a stock is likely going to go sideways or slightly higher, that's an advantage that you have in the stock market, especially when it comes to the wheel. Obviously, select the strike prices for your goals. If you don't want to get called away, you have to sell options that are further out of the money. I'm not going to get super nerdy and talk about like delta and probability touch.
I don't even be looking at that shit, man. Again, I do have you on motherfucking speed dial though if I need a fucking advice. So maybe that's an advantage. Yeah.
Another quick tip, I don't want to combine too much technical analysis with this, but if a stock has like a resistance zone, that can be a potential area to sell a covered call on. So like, for example, I own this stock VNO. What's it? Right over here. I've got a whole account just dedicated for the wheel. If you want to, you can sell options at where there's going to be like some sort of resistance, because that's going to be an area where the stock could potentially drop from. Those aren't exactly perfect resistances, but
you can use technical analysis to pick your strike price. You pick fundamental analysis, which is like the technicals, you know, price, earnings, all that shit, to pick the stocks you want to do this with, right? But then technical analysis, which is like the chart patterns and shit, to pick your entry points and your strike prices.
Exactly. And all that does is just increase your probability of success. Yeah. That's basically it. And it's really, really nice. Sell puts at demand zones and be sure to manage your risk. Don't try to do too much on one stock. Try to diversify. Maybe you have some wheels running on like silver, gold. Maybe you have a wheel running on like oil. Maybe you have a wheel running on ABR, or like maybe you have a wheel running on bonds. That way you're not all in one asset class and you got cash flow coming in from multiple asset classes.
For sure. Listen, guys, if you want to know more about this, man, you can holler at Greg. He's always in the Discord. I'm in the Discord, the Victory Unit Discord. We in there all the time, man. Listen, Greg, thank you so much, bro. That was a fantastic presentation. You really did a great job.
Oh, thank you. I really appreciate it. You did a good job too. It was fun. It's on the fly.
Teamwork, man. It's like, you know, Batman and Robin or some shit like that.
Hell yeah.
All right, peace.